The loan officer training series with the mortgage calculator. We will wait just a minute here to get started. Let us go live on all the different platforms. We put the chat up on the screen, but I see there were already some comments coming in there. Appreciate all those comments. We will get started here shortly. As everybody tunes in, feel free to drop a comment there in the chat now that we got it pulled up on the screen. Hope everybody's been having a great day. Hope all the loan officers out there were making calls and doing loans. Hopefully, everybody's got some loans going, especially in this time. Appreciate all the comments rolling in. Get started here momentarily. Remember, we do these at 7 p.m. Eastern Time every Tuesday and Wednesday. So we have another topic coming up for tomorrow as well. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. Please go ahead and keep dropping comments there in the chat as you tune in, and drop any questions you have there as well. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And every Tuesday and Wednesday evening at 7 p.m. Eastern, we do these loan officer training series. Each episode has a different topic, and tonight's topic is going to be blended rates for first and second liens. So second liens, definitely a hot topic right now, whether you're HE loans or HELOCs. Obviously, in the market that we're in right now, those are becoming ever more popular. So our sales manager, Jose, with 28 years of experience, I'll let him take over here, and let's go ahead and get into the topic for tonight.
All right, how's everybody doing tonight? While Nick brings up the presentation, I will just expand a little bit on what Kyle was mentioning regarding our current environment, where we're obviously in a rising rate environment. Doesn't look like they're going to be, going down anytime soon. Hopefully, they will be stabilizing. But what this volatility does is it creates some doubts in the potential borrowers as to should they um, refinance their existing first mortgage, or should they just get a HE loan or a HELOC, right? Now, uh, obviously, in this volatile environment that we're in right now, HE loans, which is a fixed rate option, um, is tending to gain a little bit more popularity than the HELOC, which is an open end second loan, which is going to be usually a variable rate loan on the HELOC, HE loan being fixed. Another advantage of the HE loans is that we have alternative document uh, possibilities with the HE loans. Not only can we originate the HE loans full doc, but we can also originate the HE loans using bank statement, P&L, and even DSCR, income documentation types, right? So that definitely opens up some additional playing fields there for us to consider, right? So it's not just a HELOC. Now we're talking about HE loans on a bank statements. They're all really popular now. We're seeing some good dollar size loans because it's a good probability that if your borrower um, obtained that HE loan, or that, excuse me, obtained the current first mortgage um, prior to 2022, let's say they obtained that loan sometime in 2021, they're probably going to have a 3%, 3.5%, could even have a 2.5% interest rate, right? So uh, Why would they want to get rid of that loan if all they needed is maybe 75 or $100,000? So let's get into it here. So blended rates in a rising rate environment, which is exactly what we're touching on right now, right? Current rate environment may discourage borrowers refinancing out of low interest rate first mortgages. The HELOAN and HELOCs do not require refinancing that low rate first mortgage. When you combine them through the blended process, you basically proportionately allocate the interest amount to each loan. And another very interesting component of this is that if, let's say, you have a loan that's 5 or 6 or 7 years old, on top of everything else, you have to consider the amortization schedule that you are currently in. Obviously, the longer you've had the loan, the more favorable of an amortization you're going to be in. So, some blended rate basics, right? Now, this is very important for you to consider. Now, obviously, we have, which I'm going to show you at the end of the presentation, right? There's a website you can go to that will assist you with this, but it's very important that you understand the mechanics that go into this so that you can properly explain this to your borrowers, right? Is what good does it do you going to a website and doing some calculations if you have no idea how to explain the benefits? So if you understand the calculations, you will understand the benefits. So when I'm talking about proportion, right? A blended rate is a weighted average of the interest rate on two or more loans. In this case, we're going with two loans. And when you do get that blended rate, that is what they call the effective interest rate on the combined debt. That is exactly what you are paying. And it gives you a really good picture. And usually, not always, because we've actually had some HE loans be bigger than the existing first, but the second mortgage is usually smaller than the first mortgage. So the impact on the total payment is going to be less if you're analyzing a blended rate where you're taking a new second mortgage and keeping the existing first at a low rate. It's going to be less of an impact than if you get a new first mortgage for the total amount. And you'll see why in a second. Now, how do you calculate blended rate? This is the part where we're talking about the mechanics, understanding the mechanics that go into the calculation so you know how to explain it. So it's real easy here. Blended rate equals the interest rate on the first loan. So in this case, our first loan is our existing loan times the balance on that first loan, right? So in this case, our rate on our first loan is 3.5%. The balance on our current first mortgage is $350,000. The rate that we're going to get on this HE loan that we're working on here is 11.75. Let's say we're doing a bank statement HE loan, and the balance is $150,000. So you add up the interest rates on both of those. So on both of those, the rate on the first one, 12,250 is the first mortgage payment, interest payment. And the mortgage payment on the second one is $17,625. So when you do your math, 12,250 plus 17,625 divided by $500,000 gives you 5.975%. So you see how you really got to go through the motions to really understand what's going on here, because the effective rate is only increasing from 3.5 to 5.975. Still great, a lot lower of an effective interest rate than they're going to get if they were to refinance this loan right now. They'd probably be getting 8.75% on a good day. Let's say we're doing bank statement, right? Cash out. uh, much higher than 5.975. So not really that much of a difference there because of the proportions. So putting it here a little bit better on a graph here, now you got to consider, right? Does it really save the borrower money compared to getting a new first mortgage, or is it just better to add a second mortgage or refinance the first? So our new first mortgage we see right here at 8.75%, $43,750. That's a lot of cheese. Our blended mortgage interest payment at our 5.75 blended rate, 29,875. And that's based on our existing loan plus our 11.75 rate. So when you're doing the calculations there, you see there's a considerable savings there, almost $14,000, $13,000, excuse me, between one and the other. So definitely there is a benefit here for the blended rate. And some additional factors to consider here, which is really going to allow you to, seal the deal, is going to be, for example, closing costs, right? $150,000 loan has a much lower closing cost amount than a $500,000 loan, right? It's because you got to remember some of these closing costs are fixed costs, underwriting fee, appraisal fee, but others are based on the transaction amount, like title insurance, transfer taxes, right? Those are two big figures in some areas. I mean, some areas don't really have a high transfer tax. Other areas do have a good amount of transfer tax. So definitely something for you to consider closing cost amount. Then also, are there any prepayment penalties on the existing loan? If it's an investment property loan and it was a non-QM loan, there's a good probability there's a 3-year prepayment penalty on there that has to be taken into consideration, right? I previously mentioned the amortization table. As you know, I mean, and the amortization table is available for you. You can pull one up anywhere and pop some numbers in there and see. With each payment that you make on a loan amortization, the amount of interest is going to decrease on the next payment, and the amount of principal is going to increase by the amount of the interest expense decrease. So let's say with each payment that you make, it's $1 more towards principal and $1 less towards interest. Well, after 60 payments, you got a big difference there of $60 more going one way than the other way. So that's just definitely very important to consider that if you start with a brand new loan, you're going to be in day zero on the amortization table. So besides having a higher interest expense, you're also going to have a higher interest expense when you actually consider where you were in the amortization table on the other loan versus the new loan. You're starting from zero. And then other factors to consider is just income type, right? I mean, what type of loan are you really dealing with here? Are you dealing with a DSCR loan? Are you dealing with a bank statement loan? Are you dealing with a profit and loss loan? Or are you dealing with a full doc loan? Each of those are going to have different requirements for a new first loan. Uh, and then what would be those requirements when you're looking at a first mortgage versus whatever may be the guidelines for the second mortgage? So, very good points to consider here uh, when you're analyzing this. And then, like I mentioned to you all, yes, there is a website we can go to, right? Blendedrate.com, where they do have this table where you fill out the information there for your existing first mortgage and the amortization term and amortization type, the interest rate, right? The second mortgage that you may be looking at, right? Notice this would be for a HE loan. And if it was a new first mortgage where you would be, and then the system does the calculations for you. But again, you can do those calculations yourself as well so that you can fully convey the benefits to your borrower. When you do understand what you're talking about, believe me, you're going to come across more confidently to the borrower. They do pick up those subliminal messages, and if they feel that you're sense, not that feel, they sense that you are a consultant, that you know what you're talking about, there's a good probability they're going to use you for their loan. They're going to decide to use your services. Whereas if you come across a little bit clueless, they need a consultant. That's the name of the game in this very competitive environment. And this is just one additional tool that we give you to add to your consultative services so that you can get those deals, especially with the very hot second mortgage market.
Yeah, that tool is great, guys. You can use it and then just print a screenshot for your clients as well to give them some quick snapshot numbers. Like Jose said, the math isn't complicated, but the tool makes a nice presentation kind of format for you. So great tool to use there.
So I don't see any questions, but I have just something for you, Jose. So you're saying basically uh, today we were talking about the blended rate, right? But just in terms of second mortgages, HE loans, and HELOCs in general, I know we've done other shows about them, but just in general to recap, you were saying a HELOC, variable rate, right? Home equity line of credit, that is typically only full doc. But you're
Correct.
saying the HE loans, the actual second mortgages, the fixed rate second mortgages have these other income types as well as even a DSCR for a DSCR for an investment property?
Absolutely. Yes, they do. Now, you do have to realize it's not going to be 80% LTV on that or 90% CLTV on that he loan, but they do offer a DSCR version of the he loan as well as bank statement, P&L also. Very popular. The bank statement and full doc obviously, but the bank statement one is just it's like super popular option on the helos because this is a very popular product for investors. And as we know, our investors, the majority of our investors are alt doc. They are not full doc. Your traditional full doc with tax returns, pay stubs, W-2, stuff like that. The majority of our investors, especially as their portfolio grows, definitely transition to alt doc loans only. And bank statement, P&L, and DSCR loans, right up their alley.
Awesome. Okay. I don't see any questions then, so I think we can wrap it up here. And just so everybody knows, as Jose was saying, this is hot right now. This is in our as our market keeps going the direction that it's going and keeps going up, it's just going to get hotter and hotter, right, Jose?
Absolutely. This is probably one of the more powerful trainings we've done recently because the majority of the loan originators out there have no idea what we're talking about. They're still trying to follow the agency business, right? And we're here talking this full spectrum of products that we have from our agency products to our non QM first liens to our second lien products to just understanding it by teaching you how to calculate it. Like I said, it's not very complicated, but if you don't understand it, there's no way you're going to be able to explain it to a customer in a way that they're going to understand it.
Absolutely. All right. Well, remember we do this 7 p.m. Eastern Tuesdays and Wednesdays. So we'll be back here tomorrow with a new topic as well. Thank you everybody for tuning in. Thank you, Nick. Thank you, Jose. We'll see everybody tomorrow, 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, everybody.
Thank you, everybody. Have a good evening.